Hey everyone, welcome to the KE Report, another daily editorial, this time chatting with Craig Hemke, founder and editor of TF Metals Report. We'll post a link to Craig's site in the show notes. Craig, let's talk about gold here. Gold continues to perform or hold up quite well. Right now trading around 2760. Again, the all-time high on the futures market being 2800. And I think even more importantly, just this continued strength where gold's corrections have been relatively shallow and bought back quite quickly. What are you watching in terms of the chart for gold, Craig?
Yeah, hi guys. Certainly great uptrend at present. I watch the futures very closely, and there's a lot of interesting stuff going on there with the February contract going off the board and into delivery next week, and all the interest shifting out of February into April and into June. But maybe more importantly today at least is the spot price. The spot price charging forward today, breaking through what would appear to be chart resistance near 2720, and I got a last up near about 2745. At 2745, that places it just $42 below its all-time closing high from back on October 30th. So we'll continue to watch that. Like you said, dips keep getting bought. It's almost, I wrote about that. We discussed this last week, that macrocast I wrote, and how that central bank demand kind of underpins the paper market. And when that happens, the dips are maybe more shallow than what they used to be. So when you're taking two steps forward and one step back, you're really only taking a half step back. And so then your next up move starts from a higher point than maybe it would have otherwise. And we are now definitely charging higher. That spot price is up $160 from a low back there on December the 19th. So really in 4 weeks, a little more than a month, we've had a really nice continuous rally. And with all the news pending for next week and beyond, maybe that rally will continue. And wouldn't it be nice to be making some new all-time highs? It may very well be coming.
Well, Craig, maybe this is the case. Two-part question here. Could physical finally start moving the needle because of central bank buying on the futures market? Could the physical actually wag the dog instead of the futures in this scenario? And could gold keep, if it breaks out above the $2,800 level and keeps running and really starts moving, could it drag silver up out of the funk it's been in?
Well, it is wagging the dog at least a little bit in regards that I do think that has kept a floor under the price. We watch the COT reports and we watch all the flows of where the hedge funds and the large speculators, if you want to call them that, get heavily net long, 280,000 contracts, which means the banks and the swap dealers, the commercials are short 280,000 contracts. And in the past, you get a big washback. Maybe you lose 60% of the gains you made on the way up. But now all of a sudden, we didn't even get a 10% pullback in gold until late in the year after we got to 2,800. And so now here we are moving higher again. So if those dips get bought, if there's physical demand on the dip, it really does preclude the paper price getting washed out. So as long as that central bank demand continues, that seems to be a key driver of it. Even China told us they stepped away for 6 months, but then they came back with 5 tons in November and 10 tons in December. That central bank demand certainly underpins the market. Regarding silver, lost in the hubbub of just the first 3 weeks of the year, silver's already up 6% year to date. It finished the year under 29, and now here we are pushing toward 31. So it'll be interesting to see what happens there next. Copper's been kind of helping it along as well. Copper having broken its downtrend recently. Silver will be the next one to watch. On that futures contract where the front month is March, keep an eye on that $32 level. We're not there yet, but that might be an important one to breach on our way to 33 and then 35.
Yeah, silver still has some work to do on the upside, but hey, this has still been over the last few years too a gold-led rally for precious metals. When we look to other sectors, other markets, I also find it interesting that really seems like gold is just going to a beat of its own drum. The dollar's been higher, interest rates have remained relatively elevated, and U.S. equity markets have remained, well, elevated as well. But yet gold continues to move forward. So any correlations, whether inverse or positive, to note here with other markets and the moves in gold?
Well, I tell you what, now that's something that's very interesting here because, and again, I can't recall if we discussed this last week, but the dollar index has been trading almost tick for tick with how it traded in late 2016, the first time when Trump was elected. Everybody thought this was going to be a strong dollar thing, and the dollar took off at about his election in 2016 and rallied all the way into the middle part of January 2017, when right before his inauguration, he said, I actually prefer a weaker dollar, which, again, given how he feels about trade, that's not surprising. Well, guess what? Again, same thing happened this year. And we're wondering if the dollar would roll over. Dollar's been in a steady uptrend, moving from just barely above 100 to all the way to 110 week before last. That is 10% rally, right? Even I can do that math. And that obviously impacted the metals when they pulled back. But as you said, gold's been charging along while the dollar was going up. Well, as we know, the dollar can provide either a headwind or a tailwind. If we can get a noticeable, easily identifiable top in the dollar index, that's going to provide us a bit of a tailwind for prices that are already moving up. And boy, I tell you what, big breakdown in the dollar index back on Monday while U.S. markets were closed. It was announced that at least speculation is such that there's not going to be these big tariffs that Trump was talking about, at least not initially. And the dollar index fell about 1.5 points. Tried to bounce back a little bit here on Tuesday, but it's still back down to 108 off that high up near 110 just 7 or 8 days ago. Now, it's broken its uptrend line, goes back to September 30th. It's also broken its 20-day moving average and trying to find support at this 108 level. And it might. But like I said, if we get an easily identifiable break in this uptrend and a drop through 108, a drop through the 50-day moving average, which is about 107.50, we start breaking down here. Everybody will start going, oh, look, the dollar's now in a downtrend. That'll provide a tailwind for us as well. So keep an eye on the dollar, especially this week, but next when we get into that next FOMC meeting and see how it trades through Jerry Powell and everything he has to say next Wednesday.
Well, Craig, you brought up Trump. I guess we should also make a note that yesterday was the first day of the new administration. Now, at the end of last year, we had that big rally in precious metals up through October. But when the election results were more certain and when there wasn't all the waffling about what would happen post-election, when it was a clear win, a lot of the precious metals market sold off, the gold, silver, the equities, and people said, oh, well, that fear trade is now out of the market again. Well, now we see certainty coming in, and yet gold's still doing really, really well, getting ready to break out again, and also breaking out in other currencies already. So in that kind of an environment, do you take anything away from some of this new administration's economic policies that are somehow fueling gold higher? Why would it sell off when he wins, but then when he gets into office, suddenly rage again higher? So just your thoughts on that.
Isn't that funny? It does kind of confound some of those traditional narratives, right? Like we were just talking about. The dollar going up nearly 10% in 100 days. You'd have thought, gold would fall. Gold fell 10% from late October to the middle of November, but it has since recovered, 8 or 9% of that drop. So there is not that traditional narrative, and that's certainly is. And I don't know what you could find in Trump's expected policies other than steep tariffs, what that might mean for inflation, real interest rates, all that kind of stuff. It's hard to say, hard to really narrow it down to any one thing that the Trump administration might decide or promote that could affect things one way or the other. All you can really do is just look at how, again, things are trading and try to make some sense of it. That copper turning sharply higher, breaking its downtrend line, getting above its 50-day moving average, ran to resistance about 435 a pound still. This dollar beginning to roll over. I remember seeing some stuff on Twitter from Sven Henrik 2 weeks ago about he was looking at the chart of the yield on the 10-year note and speculating that the chart was telling him that yields were going to start going lower rather than higher as everybody's been expecting. So maybe all these things are just starting to factor in a little bit and a little bit of front running of that. As you know, my forecast for this year we called inversion reversion because that positively sloping yield curve, after having been negatively sloping and inverted for over 2 years, that positively sloping curve means the recession has begun, or at least it has always indicated that in the past. So again, maybe all of this stuff is starting to get factored in. Anyway, it's a long kind of circular answer, Shad, but it is interesting to watch prices here, especially over the last Well, really, since the first of the year, has certainly have been moving up sharply and solidly, and you don't really see anything in the short term that could turn things around.
So, Craig, more in terms of the interest in precious metals. Look, price is a great determinant on what the interest is, and price keeps moving up. But you also look at the COT reports, and I also like to look at volume, especially in something like GLD, the largest gold ETF. We're not seeing huge volume spikes. Are we seeing anything in the COT reports that shows a whole lot new, different interest in the sector?
No, the open interest has been soaring in COMEX gold. It's the highest level that it's been since I think it was middle of November. Even silver's open has been higher, the highest it's been since Halloween. But a lot of that seems tied into this. Some people call it the EFP trade. It's the spread between spot versus futures, concern over tariffs and whether there'd be metal in New York to settle your short if you try to put on an arbitrage of buying spot and shorting the February futures. Is there enough metal? So people are getting long. And so, anyway, the long answer to try to tell you that the COT report is kind of messy at this point. Though the hedge fund position in both gold and silver is getting what would usually be a little heavy. But I don't want to say that that means we're going to get back in any pullback, and just because of the COT. And like I said, the pullbacks have been shallow ever since we broke out back last March. I don't want, and that GLD and the inflows, that used to be a pretty reliable indicator of sentiment and maybe predictor of price, but that hasn't worked now for a couple of years because there is no sentiment. There is no desire in the investment community to own gold. It may be a lagging indicator at this point going forward. In the end, it all gets back to that, what seems to be a pretty stout, consistent, and resilient central bank physical demand in size that just keeps putting a floor under the price, and it just keeps moving higher. And now we're going to see, as we get into the next round of earnings reports, whether some of these companies are able to continue to leverage it better and report even better earnings than reported back in the third quarter. I noticed today Agnico Eagle is within about 40 cents of its all-time closing high that we saw back in October in the run-up to their earnings report for the third quarter. So we'll see if that can continue, and we'll see how those reports look. We're getting into a very interesting time for the miners in the weeks ahead, too.
Yeah, Craig, it's going to be interesting to see how the Q4 reports come in, and even Newmont picking up a little bit lately after divesting some of its projects, bringing in some cash. People looking forward to maybe a better Q3 after the big Q4 after the big Q3 disappointment. So we'll keep our eyes peeled for how things go about a month out when some of those earnings reports come in. I want to pivot over to what you mentioned just a little while ago, though, that next week we turn our gaze back to the Fed, back to Jerome Powell. We start looking at what's happening in interest rates. Really, for the last month or two, interest rates have been going up, even while the Fed was cutting at the end of last year. Maybe not as many cuts this year. Do you think there's going to be any surprises that come out of the Fed based on how you're reading the tea leaves?
Well, here's an interesting thing. We look at the yield on the 10-year note. And again, this is something that so many folks are watching. The yield on the 10-year note peaked at 480 2 weeks, not even 2 weeks ago, 1 week ago, back on the 14th. It's now down to 457. So what is that, 23 basis points it's come down. And again, that's not something everybody was expecting. There's a lot of talk about higher yields going into this year and bonds continuing to sell off. So I don't know what that might signal for what Powell's going to do. I think we got to go all the way out to June before we get more than a 50% chance that there's going to be a Fed funds rate cut. We'll see. What did they call that? A hawkish cut back in December. No one's expecting another cut in January, but it will be interesting to see if Powell's tone, his hawkish or dovish tone, changes much next week. And again, that'll all be Wednesday, what is that, 29th, where we get the latest Fed lines and press conference. And that'll be a dominant issue next week, that's for sure.
Even with rates being a bit lower, we still need to realize that they are pretty much right around the highs that they saw last year, too, in 2024. So rates have gone up on the back of rate cuts. I think maybe a bit more of an equilibrium of the market coming to accept that there just won't be as many rate cuts as they want. But hey, this always changes, and now the Fed has really pushed back on rate cuts this year. Craig, outside of the Fed, then, what else should we watch for? What else is going to drive this gold price, not just over the next couple of weeks, but through, let's say, the first quarter, the first half of this year?
Well, as we discussed earlier, I'd sure keep an eye on that dollar index. And again, not so much that I see it, but it needs to be obvious to people that the dollar index has rolled over and has topped out, at least in the short term. So that dollar index starts moving down through the 50-day, breaking down through 107 and beyond. That could generate its own little bit of downward momentum. And when you talk about gold being priced at all-time highs and all the other fiat currencies, well, when the dollar starts to break down, that means the other fiat currencies are going up relative to it, and that would mean that the gold's about ready to be priced at a new all-time high too. So let's watch the dollar closely. And the other thing I thought I would just share with everybody here, because I thought this was an interesting way to look at it. I've made my disdain for Newmont and Barrick well known over the years. Their costs are so out of control compared to other miners. I think in the third quarter, Newmont was something like 1640 all-in sustaining costs, where AEM was like 1250. I mean, it's just outrageous, the lousy job they've done controlling their costs, and thus it keeps their margins from widening as price goes up. But as Shad pointed out, they're trying to make some strides in trimming that stuff. And why that's important, I was having a discussion this morning with Ronnie Sturfula, who puts out the great In Gold We Trust report. And he said, we really do need Newmont and Barrick to do better. And I was like, yeah, you can always just buy others. He goes, but if we're going to get the generals, we're going to get people excited about the sector, we're going to get a flow of funds. We really need Newmont and Barrick to do better, because those are the stocks that people buy. The home offices, the hedge funds, even the investors like Stanley Druckenmiller, they want to get into gold. They buy Newmont or they buy Barrick because they don't know anything about mining. And so they just buy the big names. And then so they buy the big names and they think, okay, we're going to have this great earnings report and the share price is going to go up. We're going to book a profit. And instead, their earnings are terrible because they can't control costs. Newmont goes down. The generalist investor gets frustrated and says, the hell with this. And they don't want anything to do with the sector. So Ronnie's point was, we really should be rooting on Newmont and Barrick to do better, because as these bellwether, well-known names, if they can produce gains for the hedge funds, for the home offices and the like, well, then maybe those investors will branch out and they'll start looking at other miners like Kinross and AEM and Alamos and the rest, and then maybe it'll trickle down even further. So that's just a new, different way to look at it. Newmont's probably due to report again, next week? Maybe the week after, so we won't have to wait long to find out.
Hey, I completely agree. You need that leadership from the majors. Whether you like them or not, they are the ones that would bring in bigger money and more of that generalist money. That initial money isn't going to dive down into mid-tiers or juniors because people spend all that time doing research. They buy the big boy, and they need the big boys to run to give them more confidence in the sector. That's how these guys invest. And you know what? These are some of the most successful investors in the world too. So whether you like it or not, that's what we're still waiting for. Hey, Craig, always great chatting with you. Again, click that link in the show notes. Visit TF Metals Report to keep up to date with what Craig is writing about. Craig, good chatting with you this week. Have a great rest of your week.
Thanks, boys. Go Chiefs.